July the 2nd brings the latest eurozone inflation data coming off the back of the German figure on Monday. We also see the likes of the Spanish and French CPI numbers released the Friday before that. So certainly there's going to be a period of time where we see a big focus on inflation coming out of the region as people try to gauge exactly the likeliness of an interest rate cut from the ECB. Coming off the back of a period where, of course, we've seen the Australian inflation number move towards the upside. We've got the prospect of similar kind of things for US inflation. Of course, we've seen core PC coming out on Friday as well. This is the big ticket item because really we're, in my mind, likely to see some of these central banks having to row back those expectations if we start to see inflation moving towards the upside. And we're coming off the back of a period where we saw a significant surge in Q1 in terms of inflation. We really need to see that coming off in a meaningful manner, or else it could have some really detrimental implications in terms of monetary policy in 2025 as well. So let's get into it. In terms of market expectations, we're expecting to see a decline on both headline and core CPI. Most notable within that core reading, 2.5 expected from 2.9, really substantial decline there. And that could really grab the headlines taken together, really. But you can see here, in terms of the expectation, 0.1% expected on that monthly inflation gauge. It's a similar kind of thing that we're seeing over to the US, that resurgence in terms of inflation in Q1 really starting to ease off of late. Of course, energy prices did come down somewhat, so that has helped things in terms of the headline number. But much of it is due to base effects, certainly when it comes down to that core inflation metric. Here's an idea of how things look in terms of the area as a whole. You can see the euro area kind of in the middle of this. Spanish inflation significantly higher than target, around about 3.7. And that's notable because the Spanish really led the way initially, the move back down to target, now seeing significant resurgence in terms of Spanish inflation. Italy on the other side of things, well below target. And so they really have to try and gauge exactly what the appropriate decision is for the wider group. And you would say that, that the euro area figure that's in the middle of this does seem to be around that sort of cluster of countries that are around the 2 to 3% mark, but generally in the sort of mid twos. So the eurozone figure should give us a good idea of exactly how things are going to move going forward. I don't necessarily think that they're going to wait around for, say, Belgium and Spain and Portugal to get back down to 2%. And in actual fact, there's an argument to say that they might not necessarily wait for 2%. And instead, much as how Jay Powell has stated, it's about the trajectory pointing towards a return to it. Because if you wait for a move back down to 2%, by the time you start enacting interest rate cuts, it takes a bit of time for that to work through the economy. Soon enough, you're at 1%, right? So you don't want to overshoot it. And that's what they did on the way up. The breakdown that I always provide you guys with here highlights exactly how things stand on a headline inflation perspective. The 2.57 is the current figure. Above that 2% target, you can see here that we haven't necessarily been doing all that much for much of this year, largely sort of flatlining around the 2s to 3s. And you can see here in terms of the inflation we've seen at the beginning of this year, it's been pretty significant. Look at that February, March, and April figures, 0.62, 76, and 5.8. So taking those three together, you've pretty much got a 2% inflation target having been hit there, and you're really enabled by, that move towards target is enabled by that negative November figure close to -1. Also, the January figure again was negative, but once they're stripped out, you're likely to see a significant rebound in terms of inflation. So how are we looking for this time around? Well, you can see last month we saw the 0.21 figure coming out for May. And if you look at the figure that's being stripped out for June of last year, 0.26. So, markets are looking for 0.1. So you can see that the barrier, the bar is relatively low, 0.26. Certainly, if you look at the figures we saw those preceding months. But given the fact that markets are expecting a decline, I think there is a good chance that we see a move towards the downside, maybe just 2.5, something along those lines. In terms of the annualized figures, you can see exactly here, the 11-month annualized does point towards exactly that, right? So if you take an average reading out of the last 11 months and add it on to this month, then you're looking for a move from 2.6 to 2.5. But if you look at the last 6 months, this highlights the possibility of a rebound going forward. Fast forward 6 months, where could we be? Well, 4% if the trajectory over the past 6 months is replicated. But of course, we've seen these very strong prints over the beginning of this year. Don't necessarily think they're going to be replicated, but it does highlight the possibility of a resurgence back towards that 3% marker. And arguably, unless we manage to see Eurozone inflation kept really low, 0.1, 0%, on a month-on-month basis for a while, there is a good chance that we soon start to move towards the upside. And that could happen next month. You look at the July figure from last year, it's essentially flat. So anything above 0% for next month, well, we're likely to see inflation moving towards the upside. Nonetheless, this time around, markets are expecting a decline. I think, maybe we see that 0.2% decline. I think there's a good chance of 0.1% decline. We can see in terms of the core readings that essentially what we're looking at here is, again, some pretty chunky figures over recent months. It's come back down. 0.44 was the last monthly figure. 0.35 is the figure that's getting stripped out last time around. So there is room for maneuver towards the downside, because essentially 0.35, roughly double what we're seeing stripped out in terms of the headline figure. And the trajectory has been moving towards the downside in terms of core inflation growth on a monthly basis. Again, the 11-month annualized 2.74. So, marginally below where we are at the moment. But if you look, market expectations do point towards a pretty healthy move lower in terms of core CPI. But we're still at 2.8%. We've still got a bit to go. But I think what markets are expecting here, and if it comes to fruition in terms of that significant decline in both headline and core inflation, essentially papers over any cracks that might come in the near future. Because if you look at the July figure, again, that's a negative reading. So there's a good possibility that we see a move towards the upside in both headline and core inflation next month. This time around, markets are feeling pretty confident. So I think there's a good chance that we do see disinflation. Whether we see it match those rather lofty, I say lofty, I don't know what the opposite of lofty is, but you're seeing expectations of really significant declines across both of these. I think, it's quite a significant target to have to hit, really, if we sort of come back to those expectations. You can see here 2.5, so 0.4 expected to be wiped off on the core reading, 0.2 expected to be wiped off on the headline number. So it's going to be quite difficult to match that, let alone beat it and drop by even more. So whether markets sort of get a little bit disappointed because they're expecting one thing and, they still see disinflation, but it's maybe not up to scratch in terms of expectations, that could be one way that this is playing out. But by and large, the theme around this, is likely to be one of, okay, great, we're moving in the right direction. It's going to enable the ECB to cut interest rates soon enough. And this is the outlook for interest rate probabilities for their forthcoming meeting. So as we can see, 62% chance of no change at the July meeting. And the expectation is September will see that rate cut coming into fruition. Then we look further out. So by year end, you're looking at the possibility of 2 rate cuts. That's just over 50%, so maybe 58% expectation of 2 rate cuts by year end. And then if we look through to the back end of next year, we're looking at something like a 50% chance or over 50% chance that we get back down to 2.75. So that's 100 basis points lower than we are at the moment. So if we're looking for the possibility of 2 rate cuts this year, market's currently pricing just another 2 for the next 9 months, or the first 9 months of 2025. So possibly maybe 3 over the course of next year. Still, that'll be a nice change and a potential move back down to 2.5% in terms of ECB interest rates, and certainly a lot more of an accommodative environment for businesses going forward. And that should be beneficial for some of these key indices over in the euro area. Now, bear in mind, we of course have the French election coming up, and that provides significant cause for concern if you're trading the likes of the CAC. So I've steered clear of that. I'm looking here at the DAX. Bear in mind, let's go out to the monthly time frame so you can see exactly what the long-term trajectory is. It is up. You can see here record highs have been set. And we're in this sort of retracement mode. Now you can see, if we're looking at the sort of trajectory of these moves, you can see this big sharp move high. Every single day was moving in the green, and then we've been in this pullback phase. And so for me, I see this as a likely retracement before the bulls come back into play. Of course, what happens in France also has the possibility of having significant knock-on implications for European indices. But if we're looking purely around this inflation data, there's a strong possibility that we could see the bulls coming back into play soon enough. We've seen a pullback into the 61.8 Fibonacci support level. We're starting to regain some ground. I wouldn't necessarily say that we're out of the woods per se, because I'd need to see a break up through your initial swing high, which is around here, 18651, to essentially negate the intraday downtrend that you'll be able to see here on the 4-hour chart. So we can see here this wider trend of lower highs and lower lows. So a break up through 18650 will give us greater confidence that that is over. But for the time being, yes, we're sort of fading a little bit. We could see it roll over, in particular if we see the far right's really grabbing a massive proportion of the vote on Sunday. I don't necessarily think that they're going to actually take victory on Sunday. It's most likely then going to get pushed into the second round the following weekend. But likely we could see some jitters. But if we're seeing moves around this inflation data, certainly if we manage to match expectations, I think there's a good chance that we do see a rebound. And even if we see a near-term pullback, ultimately the trend is a bullish one from a wider perspective. And so if we come into this deep fib zone between the 17760 and 17983, which is your deep Fibonacci retracement zone, then that looks like an area where we could see people really buying the dip. So whether we bottom out at the 61.8 or at the 76.4, I do see as this as a retracement before the bulls come back into play, with a break below 17398 required to negate that bullish trend for the DAX. Now, in terms of the euro, I just wanted to look at it against the Australian dollar, and in part that's because of what's happened in terms of Australian inflation. You've seen at 4% reading, well over and above the expected rise into 3.8, so 3.6 up to 4%. Markets now expecting a likely rate hike from the RBA, and that points towards a possibility of strength over and above something like the euro, where we're expecting to see them cutting interest rates. We're seeing a bit of a rebound as we're heading towards the back end of this week, but we need to see a break up through this near-term swing high here at 161612. And until that happens, this near-term rally just looks like a counter-trend rebound or retracement before the bears likely come back into play. And in particular, if we do see that nice move towards the downside in terms of eurozone inflation, that could really hammer home the point that we're likely going to see another rate cut from the ECB soon enough. So whether it's the 1.61, which is your 61.8 fib, or your 1.612, which is your 76.4 fib, I think there's a good chance that the bears do come back into play soon enough. In particular, if we see this risk-off play coming in the euro area off the back of a French election result that potentially isn't too favorable for Macron, that again could be a cause for concern for the euro. So a break up through this 1.6161 resistance level does point towards the end of this near-term downtrend that we've been seeing over the course of June thus far. But until that happens, I think there's a good chance that we see the bears come back into play soon enough, with a particular eye on, of course, the French elections, but also the upcoming inflation data coming out of the eurozone.